Give us, I guess, your thoughts on how these results came through. What were the biggest challenges during this period?
Well, there's a lot of macro headwinds. Obviously, retail market recovery has been slower in Hong Kong and China. But we have been very lucky to have the assets in Australia and Singapore. Both of those group of assets have done very well. We have also managed our capital and hedging and balance sheets well enough to protect ourselves against interest rate increase.
The Link REIT's Hong Kong retail occupancy was actually quite interesting, a record high of 98% in March. Do you see kind of retail headwinds coming from Shenzhen competition, and what are the strategies to try and maintain this share?
The Shenzhen leakage has been headlined in the media and also a lot of the analyst coverage. We think that it is manageable for us, mostly because we have community shopping centres, really people come for daily necessity. So the portfolio itself has been quite resilient. I think the big picture for Hong Kong, apart from people going to China, what we're lacking is that the government have not reversed the change in the policy to allow people in Shenzhen, for example, to come on a multiple visit visa. Until that policy comes back to reverse to where we were before 2018, where we had the peak in retail and tourist spending, that will take a while for our recovery to come.
Can you give us your views on, I guess, what you've seen in terms of this go north trend, right? We're seeing people heading more towards Guangdong province and spending their money there. Has that had a big impact in terms of Hong Kong businesses and retail?
Yeah, it is part of Hong Kong becoming part of Greater Bay Area. It is a desire for the government and the region to integrate more and for people to travel, to become more porous. And as I said, it has been a little bit more one way for us going up and less of people coming down. So I think that's something that we need to encourage the government to change. But otherwise, I mean, this is a long-term development that will continue. As a owner of shopping centres, we need to make sure that there is continuous footfall. The shopping centre needs to be interesting with the right tenant mix. With that, then shoppers will continue to come. I think that's a strategy that we have continued over the last many years and continue to protect us with a very high occupancy with a lot of tenants' demand.
Have you done anything to reposition yourself in that regard? Because I know you've also recently bought Vanke's Mall in Shanghai. Would you be looking to take advantage of more opportunities like that, particularly as a number of developers engage in necessary fire sales?
The portfolio remix has continued. We'll continue to look at ways to recycle capital and also to look at interesting assets to acquire. What I mean by interesting is they have to come at the right price. Obviously, we are demanding higher return given funding costs have gone up. And to the extent that something like Qibao Vanke Plaza will come along, we'll be very quick to react because we are sitting on a very strong balance sheet relative to a lot of our competitors. We have a team to really be able to deploy and integrate the assets into our portfolio very quickly. So we stand ready to look at different opportunities, and we are, and not just in China, but across the region as well.
In terms of having funding to take advantage of those opportunities, you've got a pretty low debt ratio at the moment. I think it's about 19.5%. If you were to see a reduction in interest rates, how would that impact your appetite for borrowing? Or if rates increase, how would that hurt your DPU growth?
Well, I think we got to a stage where we're talking about high for longer rather than higher for longer. So there is some stability in the financial market. The outlook is that at some point in time rate will come down, and that's helpful to our unit price and also obviously helpful for us when we look at the cost of capital in our investments. So in the meantime, we are standing in a very competitive situation with a very low average interest rate that funding-wise, because of the rights issue that we have done last year, that has also helped us to have a lot of liquidity, allowing us to be able to withstand what has been quite a challenging market for a lot of property owners, especially in the core and core space which our REITs occupy.
George, do you expect that you've peaked when it comes to how positive occupancy is and retail growth and rental growth more generally? Do you think there'll be more challenges from here?
Well, we have almost fully let assets across all the different property type that we have, whether it's a shopping center, office, and logistics centers that we own. What we would be mindful of is obviously tenants who decide to move on and taste of shoppers changes, tenants not doing so well and they have to move out. And we have, like the past year, 660 new leases signed in Hong Kong. Out of those, just slightly over a third are new brands. Our team continue to be very active in engaging with potential tenants to make sure that there are a long line wanting to come and lease our space.